because
development of some resources, I believe in Argentina.
yeah.
A field that is being talked about a fair bit, but I'm curious what from your level, from your 20,000 foot level, is this going to have, is the development of non-conventional resources outside of North America going to have any impact on the world supply in the foreseeable future?
I would say only marginal at this point. I mean, China would like to do, but I don't think they've made huge progress there. I mean, because again, they're so, they've got the money, they can, you know, if there's somebody living in the way, they can relocate them. So that they can move through some of those barriers. But you know, there's issues there too, right? They don't have water in places, and they've got issues also. And so we don't see it as a huge impact.
What infrastructure is lacking in the United States for us to better serve Asia on the energy side? It could be pipelines to the West Coast for products, or
No, I think we probably, you know, you know, LNG, we need to move forward with the LNG terminals. We have a number on the books, but we'll see how many move forward. The one on, you know, it would make sense to move forward with the one on the West Coast. There is one in Oregon that I've been talking about a long time, which is a favorite of mine, but nobody else. Which I think would make a lot of sense because it doesn't pull from Henry Hub, and it's pulling from different, so it would have a different impact and it's much closer. But there's a lot of resistance there, but I understand there is some movement going on that, my LNG team tells me. We're going to probably have to build more export facilities just to move more product and more gasoline, more diesel, more NGLs, more crude oil and condensate. Along the Gulf Coast, where most of it will come out of.
the Gulf Coast can serve Asia pretty effectively.
Yeah, you know, you've got the expansion of the Panama Canal, which frees up some, and that would be most likely where it will move from. I would expect. Just the way that the U.S. refining sector is and the way pipeline structure is set up for NGLs and so forth, I would expect most of it move there out of that. And then, like I said, Latin America is still going to be important. We moved, that's our Mexico, but also Brazil and other countries in Latin America are taking refined products. Over time, we would expect Europe to rationalize their refining sector, especially as it's under further pressure, and that could open up some more diesel going to Europe. If you look, but again, that's most likely some could come out of the New York East Coast area, products moving that way. You know, so. And you'll get some East Coast, you got, you know, coming from, you know, even some of the NGLs can move out of the East. So there'll be some investments required. Pipelines, terminals, and so forth will be required over time. And then it's who sets up the supply chain, right? And some companies will try and control that supply chain. So you're starting to see like oil traders, you're even buying up retail sites. So they invested in refineries, they invested in terminals, and now some are even buying retail up. So they want that supply chain, and they can trade around all that they can, right? And so you're seeing that, and they're also getting more involved in LNG. So there'll be opportunities there, but and in some ways, the big oil guys have kind of given off all that, right? They're not involved in any of that. They sold their terminals. They're not involved in LNG in any big way. They're getting out of retail. They're selling off refining. They're becoming riskier and riskier investments. I mean, companies like Exxon is better. They still have big refining at Petchem. But you look at some of the others who have sold off, a BP, a Chevron, they got some exposure, these companies do. And now you got that new ruling came out, the shareholders of Exxon voted that they're going to have to take into account the impact of CO2 greenhouse regulations on their future reserves and so forth. I need to read up more on that, but that's going to have some impact. So, you know, this is, there's risk out there for those type of guys. And I would say that, you know, you got to make your bet, right? If you're going to be an upstream company, then you're going to be just dependent on oil price at the end of the day. And then it's, well, why would I invest in a company? I'll just invest in oil and play the market that way. So, you know, but there's, I'm rambling on a little bit here. So, but this is what I'm saying. There's going to be some big changes, and this is really a deterioration that's happened over time, right? I mean, when you went from controlling all the oil and controlling Aramco to now not controlling any of that oil. And all the oil you can get access to is high cost, high risk. That changes your risk-adjusted returns.
Inside Phillips 66, one of the big refiners, right, refining companies, they tell themselves that, they kind of say what you were saying. They say that refining isn't really going to be the best thing for them to do long-term in the future, and they say that they're going to move towards chemicals. So can you comment on that? Because I don't really understand what that means.
Well, yeah, I wouldn't say I'm necessarily against. I think refining will play an important role, and some of these companies are going to be positioned well for that. If you look though at chemicals, yes, there's going to be, and I was actually made a presentation in India on this, but chemical demand is going to grow, okay? And if you look at, take for example, the U.S. uses, if I remember right, 50 kilograms per person of polyethylene, which is the major base petrol. India uses their people use something like 6, right? So they got huge growth there, right? And in terms of how much plastics will be used in petchems. So we expect growth to be there. I think, you know, if you look at the U.S. producers, they're going to have cheap feedstock. Ethane is going to be very cheap. And so they also have a good domestic market, but so they'll be able to make investments and export. The problem with that is, in general, oil the size of oil, the oil market versus the size of the petchem is an order of magnitude difference, right? So it's a much smaller world. It is. And so I think it's a combination of having refined products and being well-positioned refineries, well-positioned supply chains, access to good crude at a good price, and the ability to be structurally well-positioned, plus couple that with petchem and to manage that supply chain and not just be out there dumping, right? Not just being a commodity, but being further integrated through the chain, I think makes sense.
Yeah, so like one interpretation, correct me if I get this wrong, right? So we have this wonderful refining and petrochemical infrastructure along the Gulf Coast. So yeah, even though the chemical side of it is much smaller by an order of magnitude, it just seems like play becomes turning oil into the refined products to feed the chemical industry and then become a net exporter of the value add to the chemical business, to the part of the world that doesn't have the infrastructure to do that, right? I mean...
No, I agree. It makes sense that's why I'm saying I think it's better for us, for the U.S. to focus on the value-added exports, not this export crude and condensate, but to convert it as much as you can, convert it here into higher value products. Same way on the pet chem side, don't just export the NGLs, don't just export the pellets, but move further down the chain. Now, someone gets into transportation, right? You're not going to move plastic bags to China, but you need to move in that. So what you're going to see is, you're going to see, like in the Marcellus and that, you would expect over time that you'll have steam crackers, further petrochemical industry grow up there to serve that domestic market. Now Shell built their steam cracker there because if you draw a circle with a radius of 500 miles, or I think it is, that's 70% of the US demand is in that circle. So they feel pretty comfortable, right? They're hitting the auto sector, they're hitting other industries that are petchem users. So, which is then means you'll push more volumes, export will come out of the U.S. Gulf Coast. And that that Marcellus and Utica, some of that will be used up in the U.S. domestically. And so that you'll see that kind of shift there. But yeah, I mean, we should be focusing on value added. And that's exactly what Saudi Arabia is doing. They have refineries now. They just bought out the Motiva. They got refineries in China. They're a big refiner now, right? And they just don't want to be in the crude market. And so yeah, I agree with that.
So do you have clients in the chemical industry? I mean, is the chemical industry making the adjustment or the mindset adjustment?
Well, yeah, there's a lot of investments going on in the U.S. I think there's 15 steam crackers or something on the books right now. So yeah, we do have petrochemical clients, both U.S. and internationally. And that linkage between refining and petchem is becoming more important. And how do you maximize total value and so forth. And so, yeah, I agree. The petchem industry for the U.S. should be has some structural advantages because you have such cheap feedstock. And if you look in Asia, they're a naphtha-based feedstock. And if you look at naphtha-based versus ethane, there's a huge advantage to being ethane-based. Okay. And this all plays into the U.S. Increasing our manufacturing sector. Unfortunately, in terms of jobs, the chemical industry is not it's not labor intensive, right? It's more capital intensive than labor intensive, but there's still value add there.
Well, I mean, just as a chemist, I've been disappointed over the last year that the chemical industry didn't just blossom with lots of job opportunities, lots of research opportunities, because the feedstock prices just dropped, right? I'm just disappointed that it hasn't ratcheted up the way I was hoping.
There's only, but the demand, demand is relatively, petchem demand actually grows more than global GDP, which is different, right? Energy demand grows less. So it does but it's still only going to grow 4-5% a year. And the petchem companies they have to be cautious.
Yeah.
And people have been caught wrong-footed. They completely missed this, right? I mean, Dow Chemical was involved in the import terminal with Cheniere. They had to, I may be wrong, I think they had to take or pay the import natural gas. So nobody saw this coming. They so they were so wrong, Cheniere they became right, and there's a mindset. I'm sound like I'm preaching a little here, but there's a mindset in the U.S. business people, I think, that has lost the risk appetite to invest. If you look over the last 20 years, capital investment in the U.S. is way low. It's been low for decades. No capital investment in the U.S. It's almost, and then with that, then we have low productivity. We have below normal levels of R&D. We have below investment, low capital investment. Other than the oil industry, nobody was investing in capital. Nobody's building factories. Nobody was building, they almost like given up on the U.S. economy, the big international businesses have. So now can you get that mindset, where now it's like, okay, we got all these structural advantages, right? We got a growing population. We're still the richest country in the world. We got all this cheap feedstock. We got stable government.
Yeah, we want to do things like Google and Apple and make artificial intelligence.
So there's things that we can do there, but it takes people willing to, that risk appetite is not there. Maybe the lower taxes rate would help. Other things, investment tax credits, whatever, to get that going. And then the other thing that's, I think is another thing that hinders the economy is oil companies squeezing their supply chain so hard. Their vendors, their service providers, squeeze them so hard. Their own, and where nobody can make money, right? And this is an attitude that's just permeates everything now. All the way from extending payment terms out to 90 days now and saying take it or leave it. Freezing prices year after year after year. So what's happened is you continue to have this consolidation of profits in a smaller and smaller. Not only between capital and labor, which has had a significant, in the past, U.S., the split between value add was 55% labor, 45% capital. It's now it's like 60-40 capital. All the money returns go to capital. So what does that mean? You have no increase in wages in the U.S. for decades. Purchasing power goes down. There's no inflation, right, for consumer goods, but where is there inflation? What hits the middle class the hardest? College, which is growing at, 7-8% inflation? Healthcare? And then of course, then you got, everybody's got phones and, right? So all your those things start to add up where you're spending $1,000 for phones and cable or whatever. But so then you have no spending, so you have slow growth. The U.S. is a consumer-driven economy, so if you don't have people have money in their pocket, growth slows down. And how do you get out of this cycle is difficult. And I understand the fear though. I mean, you go to places like Asia, and you go to a place like India, and the amount of people, their cost structure is so dramatically different. They are, but that's where we need to build closer ties with where the growth is, right? I mean, I told you I got back, I was there in Asia for almost 4 weeks. Nobody asked me about Europe. Nobody said, hey, what do you think of what's happening with Germany? France, hey, what do you think the French are doing? They could care less, could not care less. That is not, we're still focusing on the old world. The new world is Pacific Basin. And you look, France has 65 million people. One state in India has 65 million people. So a lot of this is this noise that what we're hearing today. And American companies need to be more aggressive looking to the export market. The U.S. economy is still overwhelmingly domestic. 87% of our economy is domestic focused, only 13% is export. Now that's increased. I mean, back in when JFK was president, it was 95.5. So that's changing, but we still don't have enough companies who are out there in the markets. you know, working these, and so this is kind of far away from oil, but, so I'll pull back. Any other questions? Is that it?
For increased DC natural gas, we're projecting different figures out for oil. Percentage of increase, because you're saying that, you know, natural gas will continue to go in that kind of an uptick.
Yeah, so what the question is, I'm sorry.
So if we're seeing oil going from 50 to roughly 60, 65.
Oh.
What kind of?
So we're seeing, we're seeing gas prices staying under $4 for the next 4 or 5 years. And it's going to take a while to get up there, the back there, but we do see them prices starting to go up, but we're seeing it breaking through $5, I think, in around 2020 or something like that. No, wait, what is today, 2017? So I think like 2022. It's going to take a while to get up there, but we do think there'll be upward pressure on natural gas pricing will start to go up. But we do expect, in our reference case, that gap to widen, right? The oil to be at a much sharper slope than the natural gas over time.
I've got one quick question. Early on this year, we heard about the new administration wanting to introduce border adjustment tax.
Yeah.
Now, if that's moved forward, if that has gone forward, how do you think that would have affected the, let's say, for example, the oil industry in terms of import, export, and would there be retaliation by other countries? What do you think about it?
Well, yeah, in general, it's going to make it more attractive to use domestic oil than imported oil. But there's some structural reasons U.S. refiners import oil, and some of it is it's linked to equity barrels, so that's being run through their equity refineries like Saudi Arabia, or it's linked to heavy crude oil, and they can, which they can buy at a discount, and the refineries have been designed to run those heavy barrels. So it's not. So there's some structural limits to how much they can shift away from running heavy to light. In the short term, there can be problems with the overhead and not being able to process all the light ends. That's relatively inexpensive to fix over time versus the other way, trying to invest to be able to process heavy crude. So, but there'll be some shift there where it'll be more attractive to run our, domestic barrels and than imported barrels, and then it should also then help exports. It should, but how the world reacts to that is unclear. Some economists think that the dollar would strengthen significantly and rebalance it that way. There could be, but if you look where, for example, where our barrels and our gasoline are going, it's unlikely, if you're talking energy, unless it just gets thrown in with the rest, it wouldn't be to their advantage to put tariffs on it, right? Because they want our gasoline, they want our diesel. Japan wants our crude and condensate, so for them to, it's filling the need, right? So I think there would be limited reaction in terms of oil that way. It would be. Because we're actually serving a market need. It's different than other, for example, the Asian or Germans dumping automobiles into the U.S. I mean, we don't need their automobiles. We can buy other ones, right? But it's not like Japan can go out and find oil from other places that other than going back to the Middle East. And they want to diversify because they think that's a huge risk for them to be so exposed to one region that is not always very stable. So It'll be interesting. I think right now we're leaning that that will not happen, that the border adjustment tax will not be put in place. Just because of the bigger scope of things, I think it'd be unlikely. So refiners will not like it because remember, we're importing 8 million barrels a day of crude yet today.
Anything else? Thank you.
Yeah, thank you.